Okay, we'll just give it a couple of minutes for more people to join. Lovely. Okay, so we have got Katrina with us today to go through our festive finance tips webinar. It's our last webinar of the year. We estimate this should be about between half an hour and 40 minutes with room for questions at the end. As per usual, if you just want to put your questions down in the little Q&A section to your right, then we can obviously get to those at the end. If anyone has anything that they just want clarifying or any questions for Kat, then obviously, yeah, we have allowed time for that. And then there is also a short survey that we popped up at the end as well. So if anyone has got a couple of moments just to leave some feedback for us, that would be really helpful to us. So that would be great. All right, Kat, I'll leave it with you.
Thank you. Lovely. Right. Hello, everyone. This is going to be as kind of festive as I can physically make it, hence the festive headband and Christmas jumper. I have had a lot of pressure from my colleagues to try and sing to you throughout this for my 12 days of Christmas, but I don't think any of us need that. So yeah, this is going to be a bit of a generic style of webinar. I just really want to run through some financial basics really and keep this all quite light. So we'll be dipping our toes into quite a lot of different areas of financial planning here and hopefully give you lots of things to kind of take away and think about on how they're relevant for yourself and speak to your advisor on. So here we are. So of course we're doing a 12 days of Christmas themed webinar. So this is all based around the 12 days of Christmas, which I had to do lots of research into because my understanding of the song was incorrect. But we've rewritten that and we've got our 12 forms of financial planning here instead. So just as always, we'll kick off with a risk disclaimer. So of course, information here is informative. This doesn't constitute any financial, legal or tax advice. So of course, if you think that one of these areas we'll discuss today is relevant for yourself, please get in touch with your advisor or ask me any questions at the end. So first topic I'm just going to highlight on is your debt organisation. So very, very kind of basic stuff here really. It's just about making sure we've got understanding of repayments where relevant. So for example, if you've got a fixed rate loan you're regularly repaying, being aware of balloon payments at the end of that, considering refinancing if you've got the option to use zero rate credit cards and things like that. But I think with all debt organisation, the most important thing for many people at the moment is mortgages. I think mortgage management has been the biggest area of conversation in the last 18 months with interest rates obviously rising after Liz Truss in November last year. Of course, it's meant that more and more people are realising the sub-twos are potentially behind us, and now how can they manage their mortgage liabilities? So just to give you some snapshots on where rates are at the moment, we've found that for December, if I compare you to October, so comparing 2 months, we've seen a 2-year fixed rate resi mortgage come down by 0.5%, which is great. And we've seen that come by down all of the 2-year fixed, looking at these rates here from buy to let to remortgages to new purchase. And 5-year fixed rates have come down on average about 0.4. So we've seen quite a significant decrease in interest rates from October to December. So we're preparing for potentially an interesting year for interest rates next year. Of course, there's lots of different theories on what the Bank of England could do next, but I would say anyone who's coming out of a fixed period in 2024, it would be very sensible to start considering your options now. It's also just worth knowing that if you are looking to remortgage and you're still in a fixed period, you can make a change to any application up until the end of your existing fixed period. So for example, if we then see a more preferable rate come in, you can make use of that. So I think 2024 is going to be the year of hopefully a bit less remortgage madness, but worth getting involved in that early. I will just highlight as well on debt organisation, if you or you know anyone who it's relevant to does need more kind of professional intervention on debt management plans, Step Change is a fantastic charity to help people with that. So Step Change is a charity I've done a bit of work with myself historically in helping them out. So They do amazing work in helping people understand order of repayment and making priority payment plans. So second day of Christmas, I'm giving you some protection for liabilities. This is just a brief overview of what protection policies you should be considering and why. So for those who are potentially on their own, or they are the breadwinner, it's always worth considering the first protection form of income protection. Now, income protection is really simply covering your income in event of the inability to work. So, for example, most people, if they are employed, will benefit from things like sick pay after 4 days of leave, but that is quite a measly £60 a week, so isn't going to do much to pay those hefty mortgages we just discussed. So income protection policies will typically pay up to 75% of your current income for you in event of illness or sickness. Normally they have a deferred period, so typically that will be 13 weeks at minimum, up to a year at maximum. So you'd have to be off work for that relevant period of time. But nonetheless, it's a great policy for ensuring you can sustain things like mortgage payments and bills. If you're taking out an income protection policy personally, there is no tax to pay on the benefit you receive from the income protection policy. But if you've taken one out as a group income protection policy by your employer, you will pay your marginal rate of income tax. So it's just worth noting that if you are in a group scheme. So income protection, a really important policy if you are the main breadwinner in the household. For those with mortgages, it's always worth just covering that liability. So term assurance or decreasing term insurance is important there. So effectively, this is you paying a premium for the term of the mortgage with a set sum assured. That will either be level or decreasing as per the mortgage repayment, with the view being that if you pass away during your tenure, during the term of the policy, then the lump sum will pay out and hopefully assist with the mortgage liability. So a useful policy for those who are, again, potentially the main breadwinner or have a family with young children. Of course, those, again, in similar situations here, if you've got young children, you've got hefty mortgages, or you're potentially the only earner in the household, critical illness cover is a good cover to consider. Instead of waiting till death for benefits, critical illness cover will pay out in the event of a serious or critical illness diagnosis. Some policies work for serious illnesses, other for critical. An example of that would be Vitality. They have something called serious illness cover, and essentially that can pay out like in segments. So they will have, say, 25% of the policy could end early if you had a diagnosis of X, leaving 75% in for the remaining term. But critical illness cover is normally designed to, as I say, help pay off things like liabilities in the event of an illness diagnosis, or potentially give you a cash lump sum to make changes to your home or lifestyle to accommodate that illness. Critical illness is quite expensive, just to forewarn. It's one of the most expensive forms of cover, but a very valuable one. And for those who are asset rich, whole of life cover I've bolted on here, and this is really what it says on the tin. It's you taking out a policy for life, paying a premium for life, with a sum assured at the end. As long as you keep paying those premiums, that sum assured is guaranteed. So typically used for people who have inheritance tax liabilities, or they're looking to save for beneficiaries outside of their taxable estate. So again, a more expensive form of cover. Individual in their mid-60s could expect to be paying approximately £550 for £300,000 of cover. So potentially a very expensive cover if you've got a very long life ahead of you, but it's always worth doing some calculations with your advisor to see if it's beneficial. So the third day of Christmas, I'm going to bring you some emergency cash. This is just the basics on what we all hopefully are doing anyway, really, but keeping some emergency cash back is always recommendable. Typically you'll hear 3 to 6 months being the standard. I've put 6 months in here because I'm a pessimist, and I think we've had a tough couple of years economically to remind us of the benefit of holding a bit of independence outside of joblessness risk, or things like furlough coming back on the cards for some people. But essentially holding 6 months of emergency cash, we would typically recommend be done in something like a cash ISA if you're not using your allowance elsewhere, to avoid any tax on interest. or an easy access saver, either in a lower taxpayer's name or in something like a premium bond. So emergency cash should be something that's immediately accessible within 3 working days to cover either a large expenditure like the roof falling down, or, as I say, covering something like a joblessness risk. So emergency cash, often overlooked, but just very important to get right. Leading me nicely into the 4th day of Christmas on interest rates. So interest rates, again, a really kind of popular area of conversation in the last couple of months, naturally, and I think more people are starting to realise the benefits of changing the bank account versus the admin is now very much back on the table. So even if you've just got easy access savers, that emergency cash, you can still get some really good rates from either the high street lenders or the high street banks, or the online banks. So I ran these rates for us on, I think it was Friday last week, so hopefully they're still all live, but we can see at date of analysis, the best rate we had on the easy access market was with Ulster Bank, 5.2%, and Cash ISA easy access was Zopa at 5.08, which I know is still available. For those who like to go into a high street bank, if you've got them on your high street, that is, Virgin Money and Skipton both look very competitive. Easy access savings just at the 5.06% rate there. Anyone who's looking to fix, I think it's a good time to start thinking about that now, because we have seen these fixed rates come down quite significantly. If I take us back to September time, we were seeing a 6.2% rate then with Vanquis Bank. So we can see the 1-year fix now being at 5.7. There has been quite a significant fall. So forward pricing that interest rates could potentially fall into 2024. Nonetheless, Al Rayyan offering 5.7% for 1-year fixed, Gatehouse 2 years at 5.4, and JM Bank at 4.85 for 5-year fixed. So potentially some names on there you don't recognise. All of those are FSCS backed banks. Not all of them have UK origins. Al Rayyan as an example there, but they are UK domiciled now. So again, it's just worth speaking to your advisor if you want any specific recommendations or advice on where you could keep your deposits based on the rates we have at the moment. At ABN, we acknowledge that interest rates have been haywire for the last couple of years. So we have started engaging with a cash management system called Insignis. And Insignis basically offer a platform solution to cash savings. So that's where we can hold various different bank accounts or building society accounts under one online centralised login. So really useful if you're someone who's got a significant amount in cash, potentially for a set purpose. Maybe you've got cash on reserve to pay off a mortgage in 2 years, therefore limited investment time horizon, and you want a complete safe deposit option. Of course, one option would be spread it yourself across multiple different bank accounts or use national savings, but of course that doesn't always get you the best rate. So that's where a tool like Insignis can come in and help. So it's one centralised platform for managing everything in one place. So as always, we've done our independent analysis on the market here, and we've landed with Insignis being our best and preferred option. So if that's something you'd like to make use of, either drop me a note after today, or feel free to contact your advisor, because it's looking like a really useful solution. Taking me on to the 5th day of Christmas, the financial plans. So this is just really the basics on what order of financial planning we would typically work with you on. The first will always be debt provisions. We'll always be asking you about making sure you've not got any large debt you're not in repayment, you're missing repayments on, understand any CCJs you may have, and of course how you're repaying mortgages. So debt provisions will always be the first thing we'll want to discuss. Second to that is ensuring your 2 to 6 months or 3 to 6 months of emergency cash, and making sure that's kind of correctly accessible and not forming part of your investment portfolio at all. Once that's satisfied, we'll typically look at mid-term investing. So this would be thought of things like your ISAs or general investments that you might need access to in the next 5 to 10 years. So money where you've got a time horizon, but funds where you are looking to at least invest for a period of 5 years plus. Long-term investments would then be more your 10 years plus, so potentially monies you're not willing to tie up till retirement, but with a time horizon that's maybe a bit more open-ended, or funds that you can't see yourself needing that mid-term access to, but potentially money that will lead into retirement planning as well. So retirement planning, an area I think has got more and more complicated for investors in recent years, with continuous changes to the lifetime allowance and the annual allowance, keeping my job quite interesting. But retirement planning is always the fifth area we'd want to highlight and understand, and that would involve projecting out your benefits and understanding what your objectives are and how achievable they are, and of course trying to fill any shortfalls to meet that objective in future values. For those who are then in retirement, planning is kind of set, steady, and very reviewable by us or your advisor. We would then think to move on to something like inheritance tax planning if relevant. So this is just making sure we've got a tax efficient structure to your estate, you're spending wisely to account for inheritance tax, and of course we're giving advice and recommendations for how to limit that tax fairly and legally as per the tools we have. So your rough breakdown of how your financial journey will look. So 6th day of Christmas, we'll talk about ISAs. So ISA allowance is still £20,000. I underline still because we can talk about stealth tax till Christmas comes really, but still £20,000 for the next tax year, and that applies to all of the ISAs you can see listed here, cash through to your innovative finance ISAs. A rule which is sometimes referred to is that you technically shouldn't have 2 cash ISAs in one tax year. That would mean you couldn't technically put 10,000 into one cash ISA and 10,000 into another. You could if it was a different type of ISA, but that rule is being abolished in 2024. So I unfortunately don't think many people knew about it or followed it anyway, but that is being abolished from April. And that does mean then you can spread your cash ISAs across some easy access and some fixed rates should you choose to. Of course, ISA benefits will always be the tax-free nature of them, completely tax-free on interest, income, any dividends and any growth. I would just bear in mind the flexible ISA rules, which potentially are a little known benefit. I'm seeing more and more ISAs on the market now showing as flexible. Previously, there were a few cash ISA options, but now that has definitely expanded. And a flexible ISA is essentially one where if you need to take a withdrawal and you pay the withdrawn amount back in the same tax year, it doesn't use any of your ISA allowance. So for example, if you had £100,000 in a cash ISA today, you withdrew that tomorrow, you can put back that £100,000 before the 5th of April with no tax implications. So a really beneficial kind of piece of information to be aware of. Of course, if you were making a withdrawal, we would typically recommend it come from things like general investments first and foremost. But if you need to, say, liquidate an ISA account to pay for a deposit pending another sale, being aware of that flexible ISA rule is really important. Furthermore, if you do think you'll be taking an ISA withdrawal before the end of a tax year, it would just be worth checking with your provider if it is flexible. So if you have any questions on that, please let me know. Taking us on to the 7th day of Christmas with pension contributions. As I say, I think pensions have just got more and more complicated as they've tried to alleviate some of the complexities in recent years. So there is more and more to think about now if you're a retiree or approaching retirement. The first one I just want to highlight here on pension contributions, though, is salary sacrifice versus net pay. And I highlight this because it's been an area that's come up in a couple of conversations with employers I've had recently, whereby we're talking about the benefits of using a salary sacrifice instead of a net pay contribution rate. And the difference really is how you are taxed before your contributions go in. So for example, with net pay, you technically receive the salary benefit, meaning you pay your marginal rate of income tax at source and you pay your national insurance rates, both employer and employee, and then the pension contribution is made. So you don't physically make it, it's still done via the employer, but you pay your tax at source still. Any net pay contributions then need to be logged on your self-assessment tax return if you are a higher or additional rate taxpayer. Salary sacrifice, on the other hand, sees your pension contributions typically go in as an employer payment. So often I see these broken down as just one contribution each month from the employer, and the employer will deduct your salary in accordance with what you're due to pay in. Sometimes this is broken down as employer and employee, but importantly, you do not pay tax on the money before receipt. Instead, the funds just go directly into the pension scheme. So income tax is fairly like for like in the sense that net pay and salary sacrifice, you will still get your marginal rate of income tax saving. It's just when. Net pay, you obviously have a lag until you do your self-assessment, whereas salary sacrifice is instant gratification. But the one tax you cannot save is national insurance. So if you are in a workplace scheme and you think you are in a net pay arrangement, I would speak to your employer and ask why. But I would also just make sure you are doing tax returns each year to get what you're owed. And of course, that's the income tax saving. Any pension contribution will receive a tax rebate, either at source or on self-assessment. And I'll show you that in a moment. Annual allowance. So this is where we get into the lovely changes we've had since Jeremy Hunt's come in. And the tapered annual allowance is the main change here. No, another Christmassy background for you here. The tapered annual allowance is effectively the reduction in the standard lifetime annual allowance for those who are high earners. So previously, the annual allowance at its standard rate was 40,000, but on the 6th of April this year, it rose up to 60,000. Also rising was the threshold income for the tapering. So for example, we can see here the tapering starts at £260,001, whereby you start to see a reduction in your benefits. And that reduction works that every £2 you earn over £260,000, you lose £1 of your annual allowance. For example, if we're looking here at the £300,000 earner, they have an annual allowance of £40,000 they can pay in. They are 40,000 over the income limit, therefore they lose 20,000 of their allowance. And that goes all the way up to 360,000. And that's where you get to the maximum cap, which is £10,000 now instead of 4. So importantly, if you're earning £360,000 or above, you can only contribute £10,000 each year. This is relevant for employers and employees. Therefore, that's a total contribution limit. So it's just worth keeping an eye on these numbers if you are over the 260 earning threshold. It's also worth bearing in mind that if you are breaching the annual allowance, you can look back at the last 3 tax years and use any carry forward. But again, if you've not got any carry forward room and you're over the breach, you will have an annual allowance charge. That is a lovely marginal tax rate charge. So your additional rate taxpayer would have a 45% tax liability, but that can either come from the pension scheme or be paid on self-assessment. So again, please speak to your advisor if you think you're at these points, but it's very beneficial to know that the rules are slightly more flexible for 23-24 and beyond. We've got no proposed changes for this for the 24-25 tax year. And just to show you here, this is really just the basics on pension savings and their tax benefits. So we can see here the net contributions. If I get my pointer. We can see here a net contribution for a high rate taxpayer. If they put in £8,000 to their private pension scheme, that would immediately get a tax uplift of £2,000 to 10k. On self-assessment, they would log that gross contribution and receive a further £2,000 rebate. So we can see their total tax relief is 40% of the gross contribution, £4,000 in this case. Basic rate taxpayers, it's still really beneficial. I've used an example here of a non-working threshold limit because the non-worker pre-age 75 can pay £3,600 into their pension each year gross. So that means they receive a £720 tax rebate still. So this scenario is really important for a client who is basic rate on their drawdown side as well. So once in receipt of income, they're automatically 6% better off even just by washing funds through a pension. So if you want a bit more information on that, please do ask, but it's well worth considering pension contributions annually, even if you are retired and receiving benefit. So we're into the 8th day of Christmas now, and we'll talk about regular investing. So this is the debate you could potentially be having on whether it's best to be saving regularly or saving in lump sums. And you can look back on lots of different time periods here to obtain a different set of data. But I just want to show you that in a period of volatility, there are significant benefits of regular investing as opposed to lump sum saving. So giving you an example, in the 22-23 tax year, a regular investment of £50,000 into a FTSE World Fund would have been worth £617 in March 2023. Versus a lump sum payment in the beginning of the tax year, you would have slightly less at 596. So there is real benefit in a volatile environment of regular investing. You're buying units at a discounted price, hopefully for longer term growth. So if you are debating in a period of uncertainty any regular saving, it's worth having a chat with your advisor and just considering the benefit of buying a cheaper unit price. Take you to the 9th day of Christmas now, and this is reviewing your legacy investments. So nice and festive, it's thinking about what you've got and where it is, and how you can potentially ease some administration. So these days you can look at pension provider A to pension provider B and in theory get the exact same service, but it's always really worthwhile making sure you've got no protected benefits. So reviewing legacy investments should always start with, have we got any guarantees you would lose on transfer? And that guarantee could be something like a guaranteed growth rate, a protected tax-free cash, a guaranteed annuity rate. So I would always recommend, if you've got a pension scheme specifically pre-2006, please get financial advice before moving it. Of course, more generically, it's worth just considering things like charges, any access restrictions you might have, and investment range, because you might find that your legacy investments only have 10 funds you can pick from versus a universe of 3,000 elsewhere. But one question we'll always just try and understand is those motivations for reviewing a transfer. For example, is it to ease your administration, or is it to try and improve on charges? But it's worthwhile thinking about what you've got and where it is, because you might be able to get it a bit cheaper elsewhere and potentially achieve a more risk-adjusted rate of return. I'd also highlight here a question I often get asked is the whole eggs in one basket question. And of course, it's a very natural concern to feel that if you start amalgamating everything in one place, you've got only one investment strategy and only one provider. And I would just always highlight that your provider risk is actually with your funds, not with your provider. So for example, if you have a Aviva pension scheme, and that Aviva pension scheme was just invested in one Aviva fund, you have full risk with Aviva. But if that fund list was more like a BlackRock, a iShares, an Aegon, an Aviva fund, you would have relevant FSCS protection at £50,000 with each of those fund managers. So there is more benefit than you potentially think for consolidating and having one provider platform, because we can manage risk under one scheme. So 10th day of Christmas, we're talking about gifting, and I did think, can I make a whole webinar and make it present based, but I struggled with ideas on that one, to be honest. So I'll talk a bit about gifting here. So this is just really making sure you're using the allowance. So each individual has a £3,000 gifting allowance each year, and that is for the giftor, not the recipient, unfortunately. However, if you've not made gifts historically in the previous tax year, you can look back and use that gift. So if you are someone who's thinking about inheritance tax planning, it's worth noting the gifting allowance, which obtains immediate inheritance tax protection. There's something called the small gift allowance, which I think everyone does anyway without potentially knowing it, but you can make small gifts of £250 regularly. There's no rules on kind of frequency here, and that has immediate inheritance tax exemption. Of course, if you're gifting a significant sum and it's over the gifting allowances, it falls into what we call a potentially exempt transfer. And that means that if you pass away within 7 years, the value of that gift is included in part of your estate calculations. Typically, we can deduct things like gifting allowances where relevant, but again, it's just worth bearing that in mind if you are making a gift to a recipient, that you should keep a log of that. Because with all tax forms, probate is effectively self-assessment. So if a beneficiary doesn't know about it, they potentially can't log it correctly. So keeping a gifting log is really expensive, is really important. If you are someone who's thinking about inheritance tax, it's worth thinking about your gifting out of normal expenditure as well. So for example, if you're an individual who has a guaranteed income, that means it has to come from an employment source, a defined benefit or a state pension, aka an income you can't change, and that income is higher than what you're spending, you can make a gift out of normal expenditure. So for example, if you had £30,000 of annual income, but you only spend 20 of it, and that's guaranteed, you could gift £10,000 a year, and that'd be immediately inheritance tax exempt. And that's what we call a gift out of normal expenditure. I would call this a very grey area of financial planning. It's something that has to be consistent, it has to be frequent, and it has to be regular. So, for example, it couldn't be an ad hoc payment. We would typically recommend it's monthly. And again, keeping a gifting log is important, just to prove it's a gift out of normal expenditure, but that wouldn't form any of the probate required forms there. And just to stress, unfortunately, we can't create an income to make use of this legislation. It does have to be a guaranteed source of income. Gifting to trust as well is something just to consider as a side note, but I'll come on to that in this section here. So 11th day of Christmas, we'll talk about estate planning. Unfortunately, a slightly morbid segment, but something I would always encourage thinking about as maybe a one and done exercise, hopefully, just to ensure that your estate is passing on in the way you want it to. So just to come back to my previous topic of discussion, which was gifting, it is just worth noting that if you wanted a bit more control over how your recipients use your funds, you can make gifts to trust. So that's what we call a chargeable lifetime transfer. And essentially it means that you've got a trustee relationship around the money and a bit more control over how your beneficiaries gain access. So lifetime estate planning would really be that trust creation for gifting or inheritance tax planning, as opposed to things like bloodline planning, which is what you want your estate to do when you pass away. So bloodline planning could be a simple will. You'll often hear it referred to as a mirror will. So passing assets from spouse to children to beneficiaries thereafter. Very simple instructions. Often you can add wording in there for in the event of one of your children predeceasing you, or the addition of grandchildren, so that you're not having to edit the document with each grandchild you may be acquiring, I'll call it, along the way. So simple wills are still adequate, but sometimes not as sophisticated as you need them to be. In some cases, the use of a will with a trust is more advisable. And this could be for many reasons. The first I'd note is control. So you can again control with trustees how your estate is managed after death. You could set instruction. For example, you may only want grandchildren to access your funds for things like education costs or first houses, deposits, things like that. And you can set that remit from the outset. You may use a trust in what we call an interest in possession format, whereby you may want your partner or husband or wife to reside in your property on your death, but you want the actual benefits on their death to go to your children. So again, there's lots of nuances you can use trusts for. The big one I will just stress though is generational inheritance tax planning. So there is no benefit for your estate in using a trust in your will. However, if you are the beneficiary of a trust as opposed to receiving a estate via a will, that money will never form part of your taxable estate. So it just kind of bubble wraps the money is the way I think about it. So estate planning, it's something we do in-house. My colleague Laura heads up our estate planning arm. She's going on maternity leave at the end of this month, which we're very excited for her about. And we have a solution in the interim period to keep this arm of the business alive before she's back. So estate planning, a slightly morbid topic. Wouldn't recommend it over the Christmas table, but please be aware of it and make sure your documents are up to date and still reflect your wishes. And then finally, my favourite topic for the 12th day of Christmas is tax planning. So this is just getting yourself organised from a tax point of view. So interest, I mentioned earlier, interest rates obviously have peaked in the last 18 months, which is great for savers, less so for mortgage interest. But it's worth just noting that we now have the unique problem of income tax being due on that interest. So basic rate taxpayers have £1,000 of a personal savings allowance, higher rate 500, and additional rate nothing. So any interest above those levels, based on your marginal tax rate, you will be paying tax on the interest. Of course, ways to overcome that would be to make sure if you are married, you have assets that are interest bearing in the lower paying spouse's name. Additionally, you can make sure that you're making use of things like premium bonds where applicable, which are completely tax free, and your ISAs. So just being aware of that is really important. As I say, it's a unique problem we've not had to deal with in a couple of years. ISAs are naturally a solution there, just as mentioned, but so could pension contributions be. So it's worth reviewing your affordability for pension savings if you are in the higher and additional rate bands, if nothing more, and thinking about how you can maximise your income tax and also save for your retirement. So £60,000 annual allowance to work with for most people. Of course, tapering applies for those above 260. But pension contributions are going to be a really big part of financial planning, I think, now, especially with stealth tax at risk. Capital gains, this has been a big area of change in recent years, and we previously enjoyed a £12,300 capital gains tax allowance in the previous tax year. Now it's 6,000. On April 6th, that's changing to 3. So any gains on shares, any gains on a general investment portfolio or selling a property that's not your main resi, you will be liable to capital gains tax. Spousal transfers are a really good planning option here. So if you have a lower paying tax spouse, you could potentially incur a capital gain in their name to benefit from a lower tax rate by good tax planning, or potentially spread assets between the two of you and make use of a slow crystallisation of gains across many tax years. Fortunately and unfortunately, of course, where markets have been a bit challenging for investors in recent years, you can also use losses to offset your capital gains. So potentially, if you are selling a property in this tax year liable to a CGT event, you may want to talk to your advisor about crystallising a loss in any general investment accounts you have to try and offset some of that tax due. So a big topic, but if you've got any questions on that, please let me know or speak to your advisor. Income tax, again, a bit of a change in the last budget from Jeremy Hunt, but the income tax additional rates band starts at 125 from 6th of April 2023, as opposed to 150 in 2022. So hopefully most people affected are aware of that and are doing tax planning accordingly, but pension contributions would be the best thing to do if you are falling into that threshold. And then finally, inheritance tax. I think inheritance tax is a slow burner at times, but there are frequent and regular things you can do to help limit the risk, whether that's a pension contribution or annual gifting. Again, it's just really worth thinking about that when you are approaching that retirement phase of life to make sure you are well structured. So, as I say, a Christmas gift from me to you is a bit of tax planning. So that takes me to the end of my 12 days of Christmas. Of course, if you have any questions, please pop them in the chat. I can see I've got one I'll answer in a moment. Yeah, please fire any questions at me or feel free to drop me an email.
Thanks, Kat. Lots to think about for the new year there. And actually, as you spoke about tax planning as well, I think Claire is intending to do a webinar in February around that. So obviously keep your eyes peeled if you wanted some more information on that. Maybe attending that webinar would be a good idea for anyone interested. Yeah, we do have one question from Richard, and that is, what is the difference between Insignis over Raisin UK as a servicing platform?
Very good question. Effectively, they do the exact same thing. There's about 5 of them on the market at the moment: Insignis, Raisin, Flagstone, Cascade, and Hargreaves Lansdown Active Saver all spring to the top of my mind. The difference between Insignis and Raisin is that we can manage a advisor and a client relationship on Insignis, where that effectively means it can be our job to you to make changes to your underlying deposit accounts, as opposed to Raisin, where it all has to be self-managed. So in all honesty, it's answering a bit of a kind of, I won't call it laziness because that sounds unfair, but it answers the point of you not wanting to do it yourself. So potentially someone who is looking just to be completely hands-off, they can put all of their funds into Insignis, into the hub account, and then we can deposit it out of that hub account into our recommendations. But Raisin does the exact same thing. It just effectively means that you have to do it yourself. So both very good options. Every kind of company I've spoke to in that space has had slightly different relationships with banks and building societies. So number of people on their panel does change slightly.
Thank you. We have just had another one come through from Rob. Small gift allowance. You can give as many gifts of up to £250 per person as you want each tax year, as long as you have not used another allowance on the same person. So 250 times 265 days is okay?
Technically, yes. The small gifting allowance is fairly flexible in that sense. I would argue if you're making that frequent gift, you might fall into the gifting out of normal expenditure category, because it is designed to be gifting as opposed to being that frequent. But it's a bit of a nuanced question, to be honest. So yeah, yes and no. My immediate answer would be if you are making regular gifts, then yes, potentially. But I would just want to think a bit more about that and how it relates to gifting out of normal expenditure as well. Wishy-washy answer, sorry there. I think that's one to take away.
And then Jeff, thank you for a good spread of topics. Are there any plans next year to cover divorce planning? It's certainly something that we can probably suggest for our advisors. In the survey as well, guys, we actually are going to put, or we have put in a new section for anyone who wants to suggest anything that they would like to see in our upcoming webinar series for 2024. So if you do have any suggestions, please feel free to put it in there, but this is definitely something we can put forward to the advisors.
And I think in terms of divorce planning, I'm going to read that as how to prepare your estate, not potentially execute any planning there.
And then
can
we see your Christmas jumper?
Absolutely. I was hoping you'd ask.
It matches the headband really nicely.
I've put on a festive candle, but if you can smell that, something's gone wrong.
Brilliant. Well, that is the end of our questions by the looks of it. So I'm just going to pop up our survey. Like I said, it shouldn't take you too long, maybe a minute or two if anyone has got the time. I'll leave it up for the next kind of 5 minutes or so. So just leave your feedback on there, it would be greatly appreciated. Otherwise, we will see you next year, and we wish you all a very Merry Christmas.
Thanks, everyone.
Thanks, Kat.